My name is Farhan. In this video, I'll teach you how to prepare the cash budget correctly. This is question number 15, taken from 2020 Paper 2 exam. Webstar is a sole trader and has provided the following budgeted information. So within this table, we're given the amount for sales and purchases for 3 months, November, December, and January. We're also given a set of extra information that we need to include in our workings before we prepare the cash budget. The requirement for this question is to prepare the cash budget for the month of January. So we will be mainly interested in the cash inflows and the cash outflows that are relevant to January. So let's take a look into the workings and starting with the first information that we have. Sales are made on the following basis. 20% of sales are on a cash basis with a 3% cash discount. 60% are on a 1-month credit basis and 15% are on a 2-month credit basis. Okay, so we're going to start with the sales that we have made in November, which is £48,000. You can see that's given in the table. We understand that 20% of the sales that we have made in November, we are going to be collecting it in the month November itself. 60% will be collected in the next month, which is December, and the remainder 15% will be collected in January. Because we're focused in January, so we want to calculate the amount that we're going to be collecting in January only. So we take the 15% and then multiply with the total sales that we have made in November of £48,000, and that gives us £7,200 in total. Let's move to the December sales. We know the total for December sales is £55,000, and based on the requirements of the question, we understand that 20% is going to be collected in December and 60% will be collected in the next month, which is January, the month that we are concerned about. So let's work out the cash inflows in January for the sales that we have made in December. So we take the 60% that we're going to be collecting in January and multiply it with the sales that we have made in December. And that way we get £33,000 to be collected in January for December sales. Let's move on to January sales. So January sales are given as £60,000 in the table. And we understand that in the month of the sale itself, we collect 20% and also allow a 3% cash discount on that. So 20% is what we are going to be collecting in January for the sales that we have made in January. So 20% of 60,000 gives us £12,000. However, we also have a cash discount, which is also known as the discount allowed because we are giving this discount to our credit customers for prompt payment. The discount is 3%, which needs to be multiplied on £12,000. And then we get £360 as the cash discount. So the net collections in January for the sales that we have made in January should be £12,000, which refers to the 20%. And then we subtract £360, which refers to the discount that we will be giving. And therefore, the net collections in January amount to £11,640. So let's move on to the second information that we are given. A provision for irrecoverable debts is calculated at 5% on all sales. Now, the point number 2 does not really have any cash component towards it because it's a provision. So it's like a possibility, a likelihood, an assumption that we are making. And let me also show you how this 5% adds up with the rest of the question. You see how we are going to be collecting 20% in the first month of sale, 60% in the second month of sale, and 15% in the third month of sale. So when you add all these three together, 20 plus 60 plus 15, you get 95. So you might want to ask, where did the other 5% go? So that other 5% is what the business is keeping as a provision for irrecoverable debts or bad debts. Then again, point number 2, which is the bad debts or irrecoverable debts, have no cash component. Therefore, we do not have to worry about point number 2 for including in our cash budget. Let's look into point number 3. Half of the purchases are on a cash basis, with the other half being on a 1-month credit basis. All right. So if you check the workings on the right-hand side of the screen, you will see that I'm starting with December purchases. And the main reason is the purchases that we will be making in November, we are going to be paying 50% in November, and the other 50% is what we will be paying in December for the purchases that we have made in November. Therefore, the month of January isn't really coming here, and therefore we don't need to be worried about the purchases we are making in November. But let's look into the purchases we have made in December, which is £30,000 as given in the table. We understand that in December, we will be collecting the 50%, and the other 50% will be collected in the next month. Not collected, we will be paying in this case because it's a purchase. We understand that in 50% of the purchases that we make in December will be paid in December, and the other 50% will be paid in January. So payment in January will be the other 50%, and that's very straightforward calculations. You multiply 50% with £30,000, being the total purchases you have made in December, and that's £15,000 is what we are going to be paying in January. Now let's look into the January purchases, which are £36,000. We understand that we are paying 50% of the purchases we are making in the month itself. So on that basis, payment in Jan will be the 50%, and that's very straightforward as well. So 50% multiplied on £36,000, which equals to £18,000. Excuse me. So this £15,000 that relates to December purchases and this £80,000 that relates to purchases for January are the two cash outflows that are coming from point number 3. Let's look into point number 4. So point number 4 says wages were £6,000 in December and are paid in the month income. From January, they will be increased by 2.5%. So we understand that whatever wages expense the business has, they're paying for it in that same month. We also know that in December, the wages expense was £6,000, and this number is expected to increase by 2.5% for January. So to begin point number 4, we first want to work out the wages that we will be paying in January, which is simply taking 6,000 that you know from December and then increasing it by 2.5%. How do we increase it by 2.5%? So we take 6,000 and multiply it with 1 plus 2.5%, and that gives us £6,150 as the total wages that we will be paying for cash in January. In case you're confused, like how I did this directly, which is the 1 plus 2.5%. Let me break it down for you so it's easier for you to understand. So we understand that wages in December are £6,000. And we understand that there is going to be a 2.5% increase for the wages in January. So what we're going to do first is calculate the amount or the increase. For the increase. So how do we do that? So we take 2.5% and simply multiply it on the wages for December. You will see that gives us £150, which is the amount that we need to increase our wages for January. So the total wages for January in that case will be 6,000, which is the original wages from December, plus an additional 150 to account for the 2.5% increase that we are going to incur in the month of January. And on that basis, the total becomes 6,150. So you can also use this method if it's easier for you to understand. So let's look into point number 5. A loan of £45,000 is being repaid in equal monthly installments over 5 years. Interest is charged at a rate of 5% per annum and is calculated and paid monthly on the basis of the outstanding balance at the start of each month. The amount still owing at 1 Jan was £18,000. Okay, so a lot of complications are happening in this point. So take a look at the right-hand side of the screen with the workings. So we understand that 5 years equal to 16 months, which is basically 1 year being 12 months, and 5 times 12 gives you 60 months. Monthly loan repayment would be £45,000, which was the original principal, divided by 16 months and gives us £750 as the monthly repayment of the loan. We also understand that whatever interest we will be paying on this loan is charged based on the outstanding balance that remains at the beginning of the month. So based on the question, interest rate is 5% per annum and is calculated and paid monthly and is also based on the outstanding balance at the start of each month, and the amount that we owe on 1 Jan was £80,000. So that is why when we calculate the interest expense, you're going to be applying the 5% on the £18,000 that's still owed by the company, by the business, Webster, to whoever they have taken the loan from. So because the 5% is an annualized code, so what we're going to do is calculate the interest expense per annum first. So we do that by multiplying 5% with £80,000 and we get £900 as the interest that we'll be paying for the whole year. However, our concern for the question is simply for the month of January, and we also understand that interest is always paid based on the calculations we do on a monthly basis. So that is why we will have to divide the £900, which is an annual figure, by 12 months to calculate the interest expense for the month of Jan only, and that gives us £75. Again, we have found that by dividing £900, which is the annual interest expense on £80,000 worth of loan, and then we are dividing it by 12. So £75 is the interest expense for the month of Jan. And this is the cash outflow in terms of interest expense for the month of Jan. Let's move to point number 6. So point number 6 says non-current assets have a cost of £60,000 and an estimated scrap value of £12,000. They are being depreciated at 20% per annum using the straight line method. So a lot of things are happening here. So we know the assets have an original cost of £60,000. So let's highlight that, £60,000, and an estimated scrap value of £12,000. Now, what's the meaning of scrap value? Scrap value simply stands for the amount that you should be able to sell the assets for at the end of its useful life. So once the assets have been fully utilized, if you were to dispose them, you would be able to sell them for £12,000. So that is the meaning of the scrap value here. And the depreciation rate is 20% per annum using the straight line method. Now, I also need you to understand something here. If the depreciation rate is 20% per annum, does that not mean that the useful life is 5 years? Think about it. 20, when multiplied with 5, becomes 100%. So that means every year you are depreciating the non-current assets by 20%. So which means year 1, 20, year 2, it becomes 40, year 3, it becomes 60, year 4, it becomes 80, and year 5, it becomes 100. So on that basis, we could also say that 20% per annum straight line also means 5 years being the useful life. So what we are doing here is, if you want to find the depreciation per annum, so we are using the formula for cost minus scrap value divided by useful life. So that is another formula for the straight line method, in addition to the simple percentage that we apply on the original cost. I need you to understand again the useful life of 5 years comes into existence because 20% depreciated per annum on a straight line basis simply means the asset can only be used for 5 years at most. Because by the end of the fifth year, the asset would be fully depreciated, 20% times 5. So we are going to be replacing this formula with the numbers that we have got from the question. We understand the cost is £60,000. We understand the scrap value is £12,000, and then we divide it with the useful life of 5 years. And then what you get is £9,600 as the depreciation on an annual basis. But we are still not done yet. A lot of students I've seen, a lot of students who I have tutored, I've seen that they do make the mistake by stopping here and failing to divide it by 12, because you must not forget that we are only doing the depreciation for 1 month, because the cash budget is being prepared for the month of January, which is 1 month. So monthly depreciation is £9,600 divided by 12, which is £800. However, I also need you to understand something. Depreciation is a non-cash expense. What's the meaning of depreciation? Depreciation is the loss in the value of a non-current asset as it gets utilized within the business for generating revenue. That's the whole purpose of having non-current assets. They're mainly in the business, so it helps the business generate more revenue. And as these assets get used up, they lose their value, and the loss in that value is what we refer to as depreciation. It's a non-cash expense. Why? Because the loss in the value has no cash component. The loss in the value comes from the utilization of this asset, which means as the asset gets used up, it gets deteriorated, and there is less use for it at the end of its useful life. So you must always remember depreciation is a non-cash expense. We are not cutting a piece of the asset and throwing it away. So there is no real cash component attached to it. It's just an estimation of the value that we are likely to lose because of utilizing the asset within the business. So that is what on point number 7, which says that expenses including depreciation are £15,000 per month and are paid in the month incurred. We are calculating the expenses excluding depreciation by subtracting £800, which refers to the monthly depreciation, also known as the non-cash expense. And then we are arriving at £14,200, which are the expenses excluding depreciation. So all this £14,200 refer to actual cash expenses. So you must not forget to do this during the exam if you want to get full marks. Let's look into point number 8. Cash drawings are taken each month based on 8% of monthly sales. Very straightforward. We are only focused in the month of January. Cash drawings refer to cash outflows because you are withdrawing money from the business. So that is why it's an outflow. And if you want to find the cash drawings for January, you just simply take the sales that we're given for January, which is £60,000, as you will see in the table, and then multiply 8% on that, and you should get £4,800 as the cash drawings that we have made in January. Point number 9, which refers to the opening bank balance being £1,250, is something we will be using inside the cash budget. So let me take you to the cash budget problem, the cash budget main area for showing the final answer. So let me start with, so I've just got a 2-column cash budget here. So we have separated this into cash inflows and cash outflows. You can also write cash receipts instead of cash inflows. They're the same thing, so do not worry too much. You have cash outflows here. You can also write cash disbursements or cash purchases. It's the same thing, nothing to worry about here. You're not going to lose marks. So what are the 3 types of cash inflows we have here? First of all, we have the cash inflows for the sales that we have made in November, which is £7,200. And where did we get this number from? So this number, as you can see on the right hand side of the screen, that's where we got it from. The 15% that we will be collecting in January for the sales that we have made in November. Then we have done the same thing for December, which is £33,000, which refers to the 60% that we have collected in January for December sales. Then we have January sales itself, which is £11,640. And you must remember that we are collecting 20% in the month of sale itself, which would have been £12,000. But we also know that we're giving a cash discount of 3%, which in this case amounts to £360, and therefore the net collections in January would be 12,000 minus 360, which is £11,640. So once you have got all the three cash inflows in place, you just add them up and find the total cash inflows, which is £51,840. Then we do the same thing for cash outflows. We already understand why we do not include November purchases. So we only have December purchases, which we are paying 50% in Jan, and that is £15,000. And we are paying for January purchases, which is 50% of £36,000 being 18,000. So if you check the left-hand side of the screen, so you can see I've done a mistake here for December purchases. This should actually be 15,000. So let me just cross it out. And then you have the purchases for January itself, which you are paying 50%, £18,000. That's coming from here. Then you have wages of £6,150. That accounts for a 2.5% increase compared to the month in December. Then you have loan repayment, which is £750. And how did we calculate that? We know that the loan has been taken for 5 years, which is 60 months, and the loan is paid on a monthly basis. So if the original loan was £45,000, you just simply divide it with the total months of 60 and you get £750 as the monthly loan repayment. So loan repayment refers to a cash outflow. So that is why we are including this here. So many students may forget to include the loan repayment and only include the interest component. That's why you must be very careful when you're doing this in exam. For the interest, based on all the workings we have done, we understand that for the month of Jan itself, it's going to be £75, so which is what we are including here. And the rest of the expenses, after removing depreciation of £800, adds up to £14,200, which is what we have included here. Then point number 8 refers to the cash drawings that we're making in the month of Jan. And the percentage that we draw is 8% of the total sales. So 8% of £6,000 gives us £4,800. Drawings refer to outflow. That is why it's included in the section for outflow. So once you have all the numbers in place, let me just add them up quickly to check that the total cash outflows or the payments are £58,975. Just going to double check this. Yep, it's £58,975. So that's all right. So what we have to do next is subtract the total payments or the total outflows from the total inflows. Very straightforward, very simple. So you just take £51,840, which are the total cash inflows, and subtract £58,975, which are the total cash outflows, and you get £7,135. It's a negative number. I've kept it in bracket. So net cash flow is £7,135 negative, which in other words also means net cash outflow of £7,135. Then you add the opening balance that we're given in point number 9 of 1250, and you should end up with the closing balance, which is 5,885 negative, or in other words, it's still an outflow, or in other words, the business has no money in its bank account. In fact, this is an overdraft. So this is what we classify as an overdraft. the closing balance being negative at £5,885.